Our IRS tax code is designed to benefit the financially educated, business owners, and investors. It's not designed to benefit employees. How do I know this? Because I'm a licensed attorney who is not your attorney. My goal in this video is to show you how the rules work. That way you can use the system to your advantage, because the reality is investors get to qualify for lower tax rates. These are called long-term capital gains rates. Business owners qualify for higher tax breaks, because that's what the tax code says. And when you're a W-2 employee, you don't get either of those. The 7 tax breaks that I'm going to talk about in this video include: number 1, talking about section 179, number 2, how to use depreciation strategically, number 3, how to use the real estate professional status strategically, number 4, understanding section 1031 as a real estate investor, number 5, understanding ordinary and necessary to write off certain expenses, number 6, understanding how to use the S-Corp payroll status to pay less tax. And number 7, a little bonus, which is not exactly tax related, but how to protect your assets. But let me start with this. Everything I talk today is for general purposes only. If you have specific questions, talk to a licensed advisor in your area. And if you have a business and you're doing over $250,000 a year, you can check out my partner, who is also an advertiser, CommonWealth. It is a tax firm that I use myself to help manage my personal and my business taxes. So if you have a business and you're doing over $250,000 a year and you want to see if you can qualify for a free consultation, I got the link to how you can do that down in the description below. My old car was a beat down Toyota Solara, and my accountant calls me up and he says, "Jaspreet, I think you should get a new car. In fact, how do you feel about G-Wagons?" I said, "They're nice, but I don't know if I should buy one." He says, "Well, I think you might want to reconsider that." And the reason why is because section 179 says that if you buy a vehicle over 6,000 pounds for your business, you deserve a tax break for that. Now you might say, well, how does a G-Wagon relate to my business? And what he said is that because I am an influencer, I can make a claim that in order to maintain my status as a social media influencer, I need to drive around in a G-Wagon. And this can qualify for a certain amount of tax break on my taxes. Now, I didn't go out and buy the G-Wagon because I didn't feel like it was a smart purchase for me. I wanted to keep my money in my bank account and use the money to continue growing the business. But you can start to see now how you can start to use the tax code to your advantage. In 2024, according to section 179, if you get a vehicle that weighs over 6,000 pounds, such as a G-Wagon, you can get up to a 60% deduction in year 1. Let me show you what the math looks like. You are a social media influencer, meaning you post pictures of your life on Instagram, and you are making $100,000 a year, hypothetically. Now you walk into the Mercedes-Benz dealership and you see this $100,000 G-Wagon sitting right there that you want to buy. And in order to buy this $100,000 G-Wagon, you then put $20,000 down. This is not financial advice. I'm just showing you how the tax code works. So you put $20,000 down to go out and buy this G-Wagon, and then you finance the other $80,000. Well, if you qualify for this full 60% deduction in year 1, that means you get to take a $60,000 tax write-off against your $100,000 income. So you tell the IRS, hey, I have $40,000 worth of taxable income, even though you have $80,000 in the bank. Because remember, you had $100,000 of profit, you put $20,000 down in the G-Wagon, you have 80 grand in the bank, and then you take a $60,000 write-off, meaning you can pay taxes on $40,000, even though you have 80 grand in the bank. Now, in order for any of these deductions to work, you have to show the IRS how and why this expense qualifies for a tax break and why it qualifies as a business expense. This is where having a good accountant comes in handy, because if you do it wrong, you can pay penalties, fines, or end up in jail. So get yourself a good accountant, because they can help you, number 1, identify the good tax breaks, but then also help you qualify for the good tax breaks. This is what tax strategizing is all about. And if you have a bad accountant, that's why you want to start looking for a good accountant who actually helps you with tax strategizing, which brings us to number 2. Depreciation is a paper write-off. That means you get to take a tax break on your tax bill on paper, but it's not an actual expense that you have to pay out of your bank account, and real estate investors love this depreciation tax write-off. So let me show you how it works. Let's assume that you go out and you buy this $1 million apartment building. It's a commercial building, an apartment building, and you bought it for $1 million. The first thing that you have to do is separate the value of the land from the building. So I'm just going to assume that the value of the land is $200,000, and the building, this thing right here, is valued at $800,000. The reason why is because you cannot depreciate the value of the land, but you can depreciate the value of the building. Now, when it is a commercial building like this, what you do is you take 1/39th of this value. So $800,000 divided by 39, which is $20,500 a year. This is how much of a tax break you get every year for 39 years of you owning this property, just because you own this building. What the IRS says is because this building is 1 year older, you deserve a $20,500 a year tax write-off, even if your building is going up in value. Let me show you now what the numbers look like. Let's assume that this building pays out a 10% return. It's paying out $100,000 a year in profit just to keep the numbers round. Now, normally, if you have $100,000 a year in profit, you have to tell the IRS you have $100,000 in profit and you have to pay taxes on that, but not here, because don't forget we have depreciation. Because your building is 1 year older, you get to take a $20,500 write-off. Again, this is a paper write-off. You're just telling the IRS that you want this deduction, even though your property might be worth more money next year. So now you're only going to have to pay taxes on $79,500, even though you have $100,000 in your bank account. But that's just the beginning. This is the standard depreciation that you qualify for when you go out and you buy a commercial property. It's 1/39th of the value of the building. If you're buying single family homes, then it's 1/27th and a half of the value of the building, not the land. You don't qualify for this when you go out and you buy a home to live in. You only qualify for this as a single family or a commercial real estate investor. But if you have a good accountant, you can get a little bit more sophisticated, because what you can also do is you can accelerate the depreciation and take bigger tax write-offs earlier in the deal. If you want to get a little bit more sophisticated, what you could do is a cost segregation analysis. And what this means is somebody's going to walk through this property and they're going to say, this is the lifespan of your plumbing, this is the lifespan of your flooring, this is the lifespan of your walls and other things in the property. That way you can qualify for specific depreciation models for different parts of the building. That way you can accelerate your depreciation. So let's go through a hypothetical. What this means now is instead of going for this standard $20,500 depreciation a year, you're going to start off with much bigger depreciation amounts. You might be able to go out and say, I'm going to depreciate 20% of the value of the building in year one. The value of the building is $800,000. 20% of that is $160,000. That means you have $100,000 of income from rent. This is your profit. If you can do this cost segregation analysis and potentially depreciate 20% of the value of the building, you take a paper write-off of $160,000. Again, this is just on paper. This is not an actual expense that you have to pay, which means you tell the IRS, hey, I have negative $60,000 worth of income, even though you have $100,000 in the bank. Now, this is where things get even more interesting, because what if you have a job and you have an income? You might be able to take this loss and attribute this loss against the income depending on how much money you make. Or what's even easier is if you have other passive losses, if you have other real estate properties that are making you profits, you can take this loss and put it against that. But let's assume that you don't. What if you work a job? Can you take this passive loss, because your real estate income is considered passive income, can you take this passive loss and deduct it against your active income? Well, let's take a look at what the IRS says. If your gross adjusted income is $100,000 or less, you may deduct up to $25,000 of rental losses. Above $150,000, you can't deduct anything. So if your active income is low enough, you might be able to take a piece of this paper loss and deduct it against your active income, lowering your job or your business income as well. But if you don't have a low enough active income, you won't be able to do that unless you get even more strategic, which brings us to number 3. If you or your spouse can qualify for this real estate professional designation, now you can deduct this passive loss from your real estate investments against your active income and not have those same restrictions as before. The key here is to be able to actually qualify for this real estate professional designation, because this is not something that you can just do passively. This is something where you have to show material participation as a real estate professional, working in the real estate space for at least 750 hours a year. This is not something you want to take lightly, because if you do this wrong, again, you'll be penalized, you'll pay interest and fees, and you don't want to get in trouble with the IRS. This is why you want to have a good accountant on your side that can help you with this, because let's just say your spouse does not work, but she helps manages your rental properties. Well, now you might be able to qualify for this, but again, there are a lot of nuances here. Get yourself a good accountant, because a good accountant can help you qualify for things like this, or show you how to qualify for this. That way, if you have a paper loss, you're making money, you have no taxable income, you can take that loss and then deduct it against your business income or your job income, regardless of what your income is, because now you can bypass those exclusions by qualifying as a real estate professional. Again, for those of you business owners making over $250,000 a year, you can check out my partner accounting firm down in the description. And then we have number 4, section 1031. This is another favorite by real estate investors because you don't see this in other asset classes like the stock market. But what this says is you can do a like-kind exchange and not pay taxes on your profits. Let me show you what that means. So if you go and you buy this apartment complex for $1 million, it doesn't have to be an apartment complex. It can also be a single family home that you buy as a rental. The key is that you're buying this property, whether it's a $100,000 single family home or a $100 million commercial building, it does not matter. You're buying this not to live in yourself, you're buying this as an investment property. So if we buy this $1 million apartment complex and it's making you that $100,000 a year in income, you're taking this depreciation against your income because you're telling the IRS, hey, my property is a year older, I deserve a tax break. But then you go and find out that your property is now worth $5 million. You've been taking this write-off, this depreciation write-off, because your property is a year older each and every year, but now you find out that your property is worth $5 million. One of the things that you can do is you can go out and do this 1031 exchange, meaning you can sell this property, pocket this $5 million, use this $5 million to buy a bigger apartment complex that is producing larger cash flows. And if you use all $5 million to buy this property, well, then you can pay $0 in taxes on those profits. Now, you know that normally if you buy a stock for $1 million and sell it for $5 million, that you're going to have $4 million taxable income. You can make the number smaller. If you buy a stock for $1 and sell it for $5, you'd have $4 of taxable income. If you buy a piece of real estate for $100,000, sell it for $500,000, you'd have $400,000 of taxable income. But here, with the 1031 exchange, if this is an investment property and you use your profits to buy another investment property, well, now you could pay $0 in taxes today and do it again and again and again until you die and never have to pay a penny in these capital gains taxes. This is what many real estate investors do. You can now buy this property for $5 million, hold on to it for a number of years, maybe it's worth $20 million one day, and then you flip it into a bigger property, a $20 million property, take all the cash, buy a $20 million property, and now pay $0 in taxes again. And then you can do the same thing. Hold that $20 million property, generate the cash flow, make your money from the cash flow, and then flip it into a $50 million property again and again and again. If you do that and you don't sell and keep the money in your pocket, well, now you don't have to pay any taxes, and some people will do this until they die. That way then your property will then pass down to your kids, and they don't have to start at the $1 million base because it's called stepped up basis. In the IRS's eyes, your children are buying the house at the price that they get it at. So if the property is worth $50 million, you die and then you give it to your kids are essentially buying this property with a basis of $50 million. So if they sold it for $50 million, they have a $0 taxable income. This is what wealthy people are doing. They're taking advantage of this 1031 exchange to compound their wealth tax-free, because now you can grow your properties, assuming that you don't sell it to keep the money in your pocket. If you sell the properties and buy bigger properties, you can use the cash flow, potentially do a cash out refinance out of the properties tax-free, but then also flip into bigger properties as long as you own these buildings for at least 1 year and use this money to buy a bigger property. That's how the like-kind exchange works. Just make sure, again, you're using a good advisor, because there's a lot of nuances here to this 1031 exchange, and if you do it wrong, well, then you're gonna have to pay all the penalties and fees and taxes that you were trying to avoid in the first place. The fifth tax write-off that you need to understand are ordinary and necessary expenses. The IRS says that every business has the ability to take a tax write-off for ordinary and necessary expenses to run their business. Now, what you have to understand is, what are ordinary and necessary expenses? Maybe your business needs a laptop. Maybe your business needs a cell phone. And if you can use this in your business and potentially use it in your personal life, well, now you get that benefit. But you cannot take a 100% deduction on your laptop and phone if you're also using it in your personal life. It has to be a business expense. But let's think a little bit broader here. Over the next few weeks, I have to travel to Manhattan and Miami and Atlanta to do some podcasts, to do some interviews, and to speak on stage. So my business partner and I are going to have to fly to these cities. We're going to have to stay in hotels. We're going to have to eat meals and rent cars and do all of these things. All of these are an ordinary and necessary expense to run my business because I have to go there to go on a podcast. I have to go there to speak. I have to go there to meet people and have meetings. And along the way, we have to eat. Now, I should also clarify that my business partner is my wife. And so my wife and I now get to travel to these places for business, and we get to write off the cost of the flights, the hotels, a piece of the meals, and other things there because they are ordinary and necessary expenses to run the business. Again, this is where you want to have a good accountant on your side that can help you come up with what is an ordinary and necessary expense. Everybody can start a business. You don't need to make millions of dollars a year to have a business, but you can start a side hustle off of your phone, off of your computer. And now you might be able to qualify for certain ordinary and necessary expenses. If you have a food blog and you're talking about how to build recipes, how to create certain meals, and you need to renovate your kitchen, is that $40,000 kitchen remodel an ordinary and necessary expense to run your food blog? Maybe. It depends how you justify it to the IRS, and this is where a good accountant can help you determine what is an ordinary and necessary expense and what is not, because again, the tax code is a rule book. You want somebody that understands the rule book, that way you can use it to your advantage, because if you don't, well then you don't get to benefit from any of the advantages that you could. The sixth tax write-up that I want to talk about is for those of you that are business owners and entrepreneurs. If you run your business out of an LLC, you have to pay payroll taxes on all of your income. So many people start the business as an LLC. And let's assume that this business that you started is now making $150,000 a year in profit. Pretty good. Now, when you make this $150,000 a year out of your LLC, you have to pay payroll taxes on all $150,000 because that's what the tax code says. That's an additional 15.4% tax on all $150,000 on top of your income taxes. This is your payroll taxes that every employee has to pay. These are your Social Security taxes and your Medicare taxes. But one of the things that you can consider doing is changing this from an LLC to an S Corp, or an LLC taxed as an S Corp, because now what you can do is, instead of having this $150,000 as profit, what you can do is pay yourself a $50,000 salary. On this $50,000 salary, because now you're an employee of the business, you have to pay the same 15.4% in taxes, your Social Security and your Medicare taxes. And then you can take out $100,000 as a profit distribution. And now because this is a profit distribution, you don't have to pay that 15.4% tax. Now, in order to do this, your salary has to be in line with what is standard in your industry. So if you're in your industry, you should be paying yourself a $100,000 salary. Well, you would flip this. You're paying yourself $100,000, and then you pay 15.4% in taxes on the $100,000, and then you take out $50,000 as a profit distribution where you don't have to pay the 15.4%. But the whole idea here is when you make a big enough salary, you can consider switching from an LLC to an S Corp. That way you only have to pay these payroll taxes on the money you pay yourself as a salary, and the rest you take as a distribution. It's still the same amount of money that's coming into your account, but you get to keep more of it because you're switching how much is your salary versus your distribution, and that changes how much money you pay in taxes. Again, I've said this many times throughout this video, this is why a good accountant is so helpful. I'm an attorney. I use an accountant because I don't want to be in the business of trying to manage all of these taxes, because tax laws are always changing. And this brings us to number 7, the bonus item that I was talking about. And the reason why I call this bonus is because this is more on your legal protection side than it is your tax side. But I really want to mention this because as you start to invest in real estate or build your business, you're going to want to create some sort of entity, like we just talked about with the LLCs. And the reason why is because it creates a shield for you and your private and personal assets. So let's assume this is me. I'm missing the turban, missing the mustache, and I'm missing the beard. So this is me. Now, I invest in real estate, but I, Jaspreet Singh, own 0 rental properties in my name. The reason why is because if I own a rental property in my name and somebody slips and falls in one of the rental properties and the insurance doesn't cover the claim and the judge says that the tenant is entitled to $100 million, well, then they can come after my personal assets because I own the property. I don't want to do that. So instead, what I do is I create an LLC, which then owns the property. So I'm going to assume that this LLC is called Jaspreet Singh LLC. So Jaspreet Singh owns Jaspreet Singh LLC. Jaspreet Singh LLC owns the property. Now, if we go through the same scenario, tenant slips and falls. The first line of defense that you want to have is insurance. Whether you have a business, whether you're investing in real estate, have insurance. I know it is expensive, but you got to have insurance nowadays because as an attorney who's not your attorney, what I can tell you is America is the most litigious country in the world and anybody can sue anybody for anything. True story. So now you can buy this property under your LLC. Now your LLC owns this property, tenant slips and falls. The judge says, well, because you don't have insurance, we're going to have to write a $100 million judgment against the owner of the property. The owner of the property is not Jaspreet Singh, it's Jaspreet Singh LLC. And now all the tenant is entitled to is whatever is inside of this LLC. And in this instance, it is just this home. So the tenant takes the home instead of the $100 million judgment because that's all the LLC has, so they take whatever the LLC owns. They can't come after my personal assets, assuming that I keep the bank account separate, assuming that I treat this like a real LLC. But we can now also get a little bit more clever. Because let's assume that, I don't know, just for round numbers, this property is $100,000 and I was gonna buy it cash. So I was gonna deposit $100,000 into my LLC account to then buy this property. The problem is now I have 100% equity in this property, which is nice, but the problem is this equity is now at risk because if the tenant takes the property, well then they take all of my equity. So now this is where we can get a little bit more strategic. Again, good attorneys, good accountants can help you with this. Now instead of me depositing $100,000 into this LLC account, what I'm going to do is I am going to loan myself this $100,000. Jaspreet Singh loans $100,000 here. That means this property is purchased with a $100,000 loan. Now, of course, the loan is owned by Jaspreet Singh, but Jaspreet Singh LLC owns this property worth $100,000 with a $100,000 loan to Jaspreet Singh LLC. Here's why this matters. Tenant slips and falls. There's no insurance or insurance does not cover the claim. You want to have insurance. Insurance doesn't cover the claim. The judge says tenant is entitled to $100 million. So they take whatever's in the LLC. This LLC owns this property. They now take the property from me. However, they take this property which has a loan on it. They have a loan on it which is payable to Jaspreet Singh. So they take the property subject to the loan, and now instead of making rent payments to me, they now have to make mortgage payments to me. This is why, again, smart team members are so important as you start investing your money, as you start building a business, because the reality is when people realize you have money, they're going to try to take their hand and put it into your pocket and take some of it for themselves. I want you to protect yourselves, and that means getting a good accountant, getting good attorneys, having good insurance to protect you. Now, before you go, I want to give you one more resource. If you are an investor and you want to stay up to date on what's happening in the financial markets, Market Briefs is a free resource that I created. Where every day my team is breaking down what's happening in the housing market, the stock market, crypto, the global economy, and our own economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below. If you don't have any money to go out and invest, it doesn't matter what's going on in the markets. It doesn't matter if you found an amazing investment opportunity tomorrow. If the stock market glitched tomorrow and you could buy any stock you wanted for 90% off, but you have no money to invest because all of your money is going to pay off your credit card bills, well, that doesn't do you any good because now you don't have the money to actually take advantage of that opportunity.